December 2025 marks a turning point in the British property market. For the first time in 18 months, house prices across southern England are actually falling. The dream of home ownership that seemed to slip further away month after month is suddenly shifting. But before you celebrate, you need to understand what's really happening here. This isn't just a minor correction or seasonal blip. Something fundamental has changed, and what triggered this reversal will affect your finances whether you own property, rent, or are trying to get on the ladder for the first time. The question everyone's asking is simple, but the answer is anything but. What does this actually mean for your wallet? If you want to stay ahead of the UK property market and understand how these changes impact you, hit that like button and subscribe to Property Reporter. We're bringing you the latest economic and housing news you actually need to know, cutting through the noise to deliver what matters. Late November, data dropped a bombshell that most people missed in the pre-Christmas rush. House prices across southern England, the region that's been untouchable for years, are officially declining. This breaks an 18-month streak of continuous increases that pushed property values to eye-watering heights and priced out an entire generation of potential buyers. We're talking about the most expensive property region in the entire United Kingdom, where prices have historically only gone one direction. When this market moves backward, it signals something significant is underway. Buyers who've watched helplessly from the sidelines for years are now cautiously watching, wondering if their moment has finally arrived. But the data tells a more complicated story than simple falling prices might suggest. What caused this dramatic reversal? October's budget created shockwaves that are still rippling through every corner of the property market. The uncertainty around tax changes and property duties didn't just make people cautious, it left both buyers and sellers completely frozen. Confidence didn't gradually decline, it collapsed almost overnight. Viewings that were scheduled got cancelled, offers that were on the table got pulled back, transactions that were moving forward suddenly stalled out completely. Estate agents reported phone lines going quiet in ways they hadn't seen outside of major economic crashes. The market went from cautious to absolutely paralysed in a matter of weeks. Sellers pulled listings rather than accept lower offers. Buyers decided to wait and see rather than commit hundreds of thousands of pounds in an uncertain environment. This wasn't normal market hesitation, this was total gridlock. But while buyers and sellers were frozen in place, lenders started making moves that revealed just how concerned they are about the market stalling out completely. Accord, one of the major mortgage providers, dropped rates on residential product transfers by up to 10 basis points starting December 1st. Now 10 basis points might not sound like much, barely 0.1%, but the timing and the signal it sends tells you everything. These cuts affect product transfer rates, which matter to existing mortgage holders who are looking to remortgage when their current deal ends. Lenders don't cut rates out of generosity. They do it to stimulate activity and keep money flowing through the system. The fact that they're doing this now suggests they either see opportunity in the uncertainty or they're getting desperate to prevent the market from seizing up entirely. Either way, it's a clear sign that the people who control the money are worried about what happens next. And they're not alone in their concerns. Barratt Redrow, Britain's largest house builder, just posted numbers that on the surface look absolutely spectacular. Revenue jumped 33%, profits increased 26%. These are the kind of figures that should have executives celebrating and investors cheering. But here's where it gets interesting. Their outlook for 2026? Absolutely bleak. Budget uncertainties around tax and stamp duty changes have them publicly warning of limited growth ahead. Think about that for a moment. The biggest player in the British house building game just had one of their best periods on record, and they're telling everyone that tough times are coming. When the company that builds more homes than anyone else is worried, everyone else should be paying very close attention. They're not speculating or hedging their bets. They're seeing something in their forward orders and planning applications that has them genuinely concerned about the year ahead. Meanwhile, in London, ministers just made a controversial move that's being framed as pragmatic, but critics are calling a betrayal of affordable housing commitments. They slashed the capital's affordable housing quota from 35% down to just 20%. The justification? House building in London has collapsed to levels not seen in decades, and something drastic needed to be done to get construction moving again. Developments that hit the new 20% target will get fast-track planning status, jumping the queue and getting approval in months rather than years. But here's the catch that's got housing advocates furious. 60% of that already reduced quota must be at the cheapest social rent levels, which sounds good until you realise the overall number of affordable units is being dramatically cut. Critics argue this trades long-term affordability for short-term construction numbers. The government gets to point to more houses being built. Developers get easier approvals and lower affordable housing obligations. But the people who desperately need affordable housing in the capital? They're getting a smaller slice of a pie that wasn't big enough to begin with. So falling prices should be good news for buyers, right? Not so fast. There's a paradox at the heart of this market shift that's trapping it in place. Sellers are holding back rather than accept lower valuations, which means supply is actually shrinking at the exact moment prices are dropping. Developers are slowing projects or putting them on hold entirely due to all the uncertainty around costs, regulations, and demand. What you end up with is lower prices combined with limited supply, creating a market that's not improving, it's just stuck. First-time buyers might look at falling prices and see opportunity, but getting a mortgage approved in uncertain economic times remains incredibly challenging. Lenders tighten their criteria when they're worried about the future. Deposit requirements stay high. Income multiples get more conservative. The dream of home ownership might look slightly more affordable on paper, but the path to actually securing that property hasn't gotten any easier. The psychology driving this market is fascinating and frustrating. In equal measure. Commentators keep suggesting that post-budget clarity will restore confidence and get things moving again, but that word might is doing an enormous amount of heavy lifting in that statement. The market is essentially waiting for signals that may or may not come. Will interest rates drop further and make mortgages genuinely affordable? Will the government introduce new property incentives or first-time buyer schemes? Nobody knows, so nobody wants to move first. Sellers don't want to list their properties during a decline because they'll have to accept less than they think their home is worth. Buyers don't want to purchase when prices are falling because nobody wants to catch a falling knife and watch their biggest investment lose value the moment they complete. This standoff between buyers and sellers, each waiting for the other to blink, could define the entire market through spring 2026 and possibly beyond. Southern England's housing market is entering genuinely uncharted territory after 18 months of steady growth that seemed unstoppable. The combination of falling prices, reduced affordable housing targets, and pessimism from the country's biggest house builders paints a picture that's far more complex than simple headlines suggest. For some people, particularly those with cash reserves and secure employment who've been waiting for prices to come back to earth, this represents genuine opportunity. For others, especially existing homeowners who are counting on property wealth or those in precarious financial situations, this is a warning of tougher times ahead. The rental market is absorbing people who can't or won't buy, pushing rents higher even as house prices fall. Young people are stuck between unaffordable purchases and increasingly expensive rentals with no good options in sight. One thing is absolutely certain though, the market that emerges from this transition period will look fundamentally different than the one we've known for the past decade and a half. Whether you're buying, selling, or renting, the decisions made in the next 6 months will echo for years to come. The British property market has always been about more than just houses and prices. It's about wealth, security, and the kind of future people can build for themselves and their families. Right now, that future is more uncertain than it's been in a generation, and how this plays out will shape the economic landscape of the United Kingdom for decades to come.